We backtested buying stocks below their discounted cash flow fair value across 25 annual periods, 2000 to 2025. The strategy returns 7.91% per year versus 7.33% for the S&P 500, turning $10,000 into $67,051. That's a small but real edge of 0.58 percentage points annually. On a risk-adjusted basis, SPY still wins. Here's everything that went right and wrong. The universe is all U.S. stocks on NYSE, NASDAQ, and AMEX above $1 billion market cap with positive free cash flow. We compute intrinsic value using the Gordon growth model. Free cash flow times 13.67. The multiple you get from a 2.5% terminal growth rate and a 10% discount rate. Stocks trading more than 20% below that computed fair value. Enter the long portfolio. Top 50 by free cash flow yield, equal weight, rebalanced annually in April. Execution is at the next day close, not the signal day close, to avoid look-ahead bias. We computed the DCF ourselves from financial statement data. This doesn't depend on any provider's pre-built model. The data goes back to the 1980s, but we start at 2000 for 25 full annual periods. Point-in-time data matters. We apply a 45-day filing lag and an 18-month staleness filter. Revenue and cash flow figures at each rebalance date use the most recently filed annual report, not current quarter estimates. Transaction costs are size-tired, 0.1% for stocks above $10 billion market cap, 0.3% for $2 billion to $10 billion, 0.5% for below $2 billion. That's more realistic than a flat rate because the portfolio tilts toward mid-caps. Buying below intrinsic value is the oldest idea in investing. Graham recommended purchasing at least 33% below fair value. Buffett targets even larger margins. We use 20% as the entry threshold, knowing that some of the discount is noise in the model. DCF backtests face challenges that price-to-earnings or price-to-book backtests don't. Every DCF backtests is really testing the model plus the concept. If the model uses aggressive growth assumptions, discount stocks might not be truly cheap. Our fixed 13.67 times multiple is one parameter set, not the definitive answer. A stock trading at an 8.78% free cash flow yield or higher is equivalent to a 20% plus discount to intrinsic value under this model. Higher free cash flow yield means a deeper discount. The simplicity is the point. One set of assumptions applied uniformly across the entire universe. No analyst bias. The data speaks. Here are the numbers from 2000 to 2025. The strategy beats SPY by 0.58 percentage points per year over 25 years, with a compound annual growth rate of 7.91% versus 7.33%. In dollar terms, that's $67,051 versus $58,591 for SPY on a $10,000 starting investment. The edge is small but real. The catch is on the risk side. Volatility ran at 30.08% versus 21.20% for SPY. Max drawdown hit negative 59.79% compared to negative 39.33%. The Sharpe ratio tells the real story. 0.196 versus 0.251 for SPY. On a risk-adjusted basis, the strategy lags. You're taking substantially more risk for not much extra return. Beta of 1.193 confirms the leverage effect. You're amplifying market moves in both directions, not generating independent alpha. The pattern across calendar years still shows the regime dependence. Post-crash recoveries and value cycles produce the biggest excess returns. Growth-driven rallies produce the biggest deficits. Three patterns explain the performance. Post-crash recoveries are the sweet spot. In 2000, 2003, 2009, and 2023-2024, discount stocks outpaced SPY. Fear created real bargains and mean reversion did the rest. Value-friendly regimes also produce strong results. When the market rotates toward value, free cash flow yield is a clean signal. These periods often follow rising rate environments or growth stock sell-offs. Growth and momentum rallies are where it hurts. 2018 through 2021 was painful, a multi-year stretch of underperformance. When megacap tech drives everything, stocks trading at 8.78% free cash flow yields don't show up. You're systematically excluded from the market's biggest winners during those periods. Financial crises amplify drawdowns. 2008 was brutal. High free cash flow yield stocks skewed toward financials and cyclicals that got hit hardest. The beta above 1 means the strategy amplifies drawdowns, not just rallies. Late cycle periods also struggle. As cycles mature, stocks that screen as cheap are often cheap for fundamental reasons: deteriorating cash flows, industry headwinds, management problems. The model uses trailing free cash flow, which can overstate the health of a company approaching a downturn. Model assumptions matter. Our 13.67 times free cash flow multiple is one choice. Change the growth rate from 2.5% to 3.5%, and the implied multiple shifts meaningfully. Change the discount rate from 10% to 9%, and the same thing happens. Different assumptions produce different discount stocks. We're transparent that this tests one specific parameterization of DCF investing. The drawdown at negative 59.79% is a real cost. An investor who bought at the wrong peak would have lost almost 60% of their portfolio before recovering. That takes real conviction to sit through, and most people can't do it. Trailing free cash flow isn't forward free cash flow. A company with $500 million in free cash flow last year might have $200 million next year. If it's cyclical or facing secular decline, the model treats trailing free cash flow as a proxy for normalized cash flow. That works on average across the portfolio. But individual positions can be traps. Sector concentration is structural. High free cash flow yield stocks cluster in energy, financials, and industrials. The portfolio isn't diversified the way an index is. The Sharpe ratio at 0.196 versus 0.251 for SPY means you're taking substantially more risk for not much extra return. DCF discount works best when it agrees with other value signals. When P to E, price to book, and free cash flow yield all point to cheap alongside the DCF discount, conviction is higher and results improve. As a standalone signal, the edge does not survive honest execution costs. That's what the data shows across 25 years and 25 annual periods. Full results, charts, and the backtest code are on the blog. Link in the description. The strongest use case is combining DCF discount with other value signals in a multi-factor screen. Run the screen yourself on cetaresearch.com. Subscribe for more backtested strategies every week.